So in light of the potential upcoming volatility in the next 2 to 3 weeks, I think the word on the street or the consensus for now is that unless we get some sort of a closure between the US-China trade negotiation, if not, whatever we have observed last week on Friday is probably just day one, and we can expect more volatility to come. At least yesterday, when I released my first video, I did explain what I'm actually doing, especially during this downtime. And the long and short of it was that I ran through a very quick traffic light exercise on my existing portfolio positions, which gives me a very general understanding of where my portfolio currently sits and how do I make sense based on my recollection of the company. And that was basically step one or phase one of this action plan, to reflect and to get some sort of a sense check on individual positions. So phase two, which is the current video that you're watching, is to really dive deeper to understand your current positions, relook at all the different theses, and to also recrunch the numbers again, especially given the recent run-up. Because I know a lot of you probably have experienced a huge bull run in 2025, and you don't necessarily have the discipline to sit down with the portfolio of companies every quarter to update your thesis, update your thinking, and to update the numbers. Myself included, by the way, I'm guilty as charged. So with this recent run-up and this more, bloated valuations, it's also important to kind of know what the assumptions are that they're trying to price in today and whether you're still comfortable with them or not. And then we can make the decision from there on. Be honest, how many times have you heard of me talk about Longbridge Singapore? And yet, you're still leaving money on the table. So you're paying fees you don't need to pay, parking idle cash at near zero rates, and skipping stock rewards if you just follow a simple plan. First, if you sign up today, you get to enjoy lifetime $0 commission on US, Hong Kong, and even Singapore stocks. Second, you receive an exclusive 12% interest boost coupon for 90 days on deposits up to 2,000 Singapore dollars, plus an additional 18 Singapore dollars worth of cash coupon if you use my link below. And if you're aiming for additional stock rewards, the rules are pretty simple. Open the account, deposit, complete buy trades within the guidelines, and hold your funds. So on the first tier, you have to keep 2,000 Singapore dollars for 30 days and to make 3 subsequent buy trades. You then get to enjoy $40 worth of Nvidia shares and $40 of Apple shares. On the second tier, you deposit 10,000 Singapore dollars and maintain it for 90 days. 5 buy trades, you get $135 worth of Nvidia plus Apple. And on the last tier, tier number 3, deposit 100,000 Singapore dollars, keep it for 90 days, do 8 buy trades, and enjoy $385 worth of Nvidia plus Apple shares. So the rewards are not stackable, so pick your level and execute accordingly. And this special welcome offer is for new Longbridge Singapore users, and it is valid until the 31st of October 2025. And with this in mind, for my Singapore viewers, please go and grab your rewards today. And thank you Longbridge for sponsoring this video. And of course, we're not running a billion-dollar investment bank or hedge fund here, so it doesn't have to be a 4,000-word sell-side analysis because you are ultimately answerable to yourself. Instead, I think it's more important for you to walk through and think through the investment idea in a more controlled and rational environment so that the future you can refer to this analysis before making any potential rash decisions in the future. So for my style, at least based on how I structure the presentation, I look at a few big pointers. First, of course, it's the investment thesis or summary or hypothesis. Depending on how you see it, you try to restrict it to 3 to 5 salient points, and then you move on to the antithesis or the bear case, and to pick the top 2 to 3 names or factors that will move the needle. And specifically, you can also add in your counter arguments if you have or wish to, which could be potential deal breakers as well. And of course, after the bull and bear case, you can then put in a valuation range after reasoning about the business and to translate your bull and bear thesis into some of these actionable inferences when you look into their valuations today. And last but not least, you can also add in personal comments or remarks based on optionalities, catalysts, or what do you think the market is missing. And of course, we are not in the business of doing a buy or sell recommendation here, but it's more so for internal usage. And some very big creators like Joseph Carlson himself also did share before his own internal document about his investment summary and has comments on different major companies in his portfolio. So I think in general, it's just very good practice of penning your thoughts down so that you don't start to do some sort of a mental gymnastics, especially when the price start to go against you. And just a side note, don't forget to also help smash the like button whenever you are at it. So how am I going to do this investment sharing? Similarly, I'm going to break down the top 9 positions of my portfolio. Even though yes, I do have 15 names, but why only the top 9? Because they actually make up close to 95% of my entire portfolio exposure. And understanding just the top 9 puts me in a very good headspace and some sort of a mental clarity, if you may put it that way. So let's start off with the first company on my list, which is Alibaba, and it makes up roughly 30% of my portfolio. And this is exactly how I would break down every single company. So of course, we first have the investment thesis column, and I split them up into the before and after section because there seems to be a very significant change, at least over the last 2 to 3 years. Previously, Alibaba actually turned from a high growth tech company in 3 distinct arms on e-commerce, cloud computing, and fintech, transiting over to basically no growth due to multiple reasons, especially with regards to the competitive pressures in e-commerce from Pinduoduo and Douyin, and also the slowing macro backdrop in China. And the bullish thesis for them for the longest time ever was always about valuations. They had great solid assets and adoption and extremely under-monetized network effects, and management team just seemed to be unable to unlock a lot of all these value. And given the extreme pessimism being priced into the stock back then, all they had to do was to stabilize the main e-commerce business, print the cash flow as they did, and do share buybacks. And the other businesses include their end financials, logistics network, their food delivery arm, their cloud, and their portfolio of companies. Everything is considered basically free of charge. But currently, I think when you look at Alibaba again, I think the story or the narrative has changed. Alibaba evidently sits on 2 of the most important Chinese tailwind today, which is firstly on consumption and secondly on this entire AI and cloud tailwind. And Alibaba is definitely the de facto China and AI cloud company today. So the main business has also shown signs of stabilizing, the margins are improving, and the growth for their cloud business has also started to re-accelerate again. And the new management team being installed, taking over from the previous era, has also started flexing the muscles of their business synergies. And moving on to the bear case, I think previously, many investors were afraid that Alibaba would turn into a classic value trap, as we have seen margins, free cash flow, revenue started stalling, growth started slowing, and the main business will start to be competed away. But currently at least, concerns are completely different. 380 billion RMB AI and cloud spend is now center of the entire business ethos. So free cash flow from the e-commerce arm is also going to evaporate, and they are dipping into their cash reserves and also starting to leverage their balance sheet through convertible bonds. So the KPI has essentially shifted, and management must now be able to translate this spending into sustained cloud share gain and growth, and hopefully being profitable as soon as possible too. Plus, at the end of the day, translate the return on investment for their customers as they onboard them onto their cloud and AI solutions. And on the side, I'm not forgetting that they have this cash burning hobby today in the food delivery space, although this is not top of mind because Alibaba is currently driving the conversation and calling the shot. And of course, the general concern for many of these Chinese companies is that they can keep innovating and continue to provide good services, but they're unable to accrue to shareholder returns as they keep their prices down due to crazy price wars. So I've basically tried to underwrite all the different risk factors around Alibaba today, from the most important and in the most immediate and short term to the longer term. And taking all these into consideration, when looking at their valuations today, I basically use their Q1 2025 numbers on a trailing 12-month basis, apply a 10x EBITDA multiple on their China commerce business, which is mainly on Taobao Tmall, and to apply a 6 times price to sales on Ali Cloud, and that gives us 700 billion RMB. You add both of them together, they equate to roughly 380 billion US dollars. And that is where Alibaba is trading at today. $159 per share on their American depository receipts. So the long and short of it is that this is basically what the street is currently estimating, looking at just the China core commerce and also their Ali Cloud and applying the respective multiple. Everything else, I think, like we said again, it's still considered quote unquote free of charge. So is this considered a fair valuation? My own personal remark and comment is that I think considering that Alibaba is now fully aligned with the general agenda of the country, we must also see it in their numbers, and they have to re-accelerate their cloud growth to more than 30% year on year again. And then I think it very easily would justify the 6-time price to sales. And the market, in my own sense, still seem quite skeptical and are unwilling to price them at a significant enough premium. Moving on to the second position, which is Tencent. For Tencent, in terms of their investment thesis, I think they have always commanded a premium over its other tech peers, even during times of uncertainty, until, of course, the government eyes on their gaming arm. So the main engine for Tencent is definitely WeChat. It's the crown jewel of the business. It gives them an insane, unfair advantage from a traffic and data point of view. So they are basically a Meta, Visa, Google, Sony, and Berkshire combined. So for Tencent, they can very easily track demand insights, emerging trends, merchant needs, game IP opportunities, and investment targets, which is hence reflected in their monstrous portfolio of both private and public investments. And till date, there is no other company coming close to dethrone their lead in messaging, gaming, advertising, and fintech. So they're basically China's digital utilities company, and they monetize an existing captive base across multiple verticals at a very low incremental cost. So in terms of their antithesis, I think the general sense is that as we operate in the general Chinese operating system environment, the regulatory climate is always top of mind. And we've actually seen it play out during the 2020 to 2022 period with the gaming clampdowns, which could come in licensing bottlenecks, user and monetization restriction, etc. And WeChat is also heavily regulated in China today, and it does not necessarily have some sort of a global appeal, and it could be seen as both a boon or a bane. In terms of their valuations today, their earnings per share is still expected to grow between 10 to 13% in the coming 3 years. And given my own assessment, I think a forward PE of between 20 to 24 times is considered fair. They're currently sitting at roughly 22 times. So their free cash flow yield is at 2.62%. And I think one natural question that will pop up is that why don't use a discounted cash flow for many of these tech companies? I think on one hand, I do agree that they're considered pretty matured. We do have a pretty long track record in terms of trying to model out their free cash flow. But on the other hand, also because we are currently in this whole AI capital expenditure cycle, they're all going to start spending money like crazy. The free cash flow margin that we've seen over the last 5 to 10 years, I'm not too sure whether those are still fair assumptions to come. Henceforth, I try to use other forms of valuation metrics when I look at these companies. So for Alibaba, I use something like sum of the parts. For Tencent, I look at forward PE. Free cash flow yield now probably looks a little bit out of whack as their free cash flow continue to go down, even though their earnings and operating income continues to go up as they drive that capital expenditure cycle. And to me, I think all things considered, I think they are commanding a pretty fair multiple. In fact, some of you might argue that they're undervalued. I think I'll leave it up to you to decide. I'm just penning my thoughts down so that I can hold myself accountable and to not make up stories in the future. So a few remarks or comments on Tencent's business today. So Tencent, as a tech company, they're adopting a much more measured and laid-back approach in this new AI frontier. They're not committing hundreds of billions of dollars in capex and build-outs, unlike Alibaba. So they're adopting a completely different strategy or approach here. And instead, they are focusing on distribution across their services. So how will this strategy ultimately play out? I think time will tell. So everything definitely looks pretty good for Tencent today, hence the very strong recovery. But oftentimes, I think investors are more afraid of the unknown unknowns. And for some investors, they might be uncomfortable with the Chinese macro regulatory risks, so they stay away from Tencent. But I think Tencent do have some sort of a track record in showing some sort of a dynamism in interacting with this regulatory environment and consistently bouncing back. So that's not too much of a big concern for me, at least for now. So moving on to Alphabet, which is the parent company of Google, here's my investment thesis. So I believe Google has one of the deepest reservoir of information, whether it's through text, through images, or through videos, etc., to build out the strongest AI stack. So the search business continues to be resilient as well, growing low double digits in light of the entire ChatGPT concern. So Google Cloud is also increasingly becoming an important piece through its growth and winning the market share of smaller developers. And they've been adopting the bundling option through Microsoft's playbook to try to get the normal consumers on board through its Google Suite and its Gemini offers. So outside of search, I think they still have cloud, YouTube, subscription, and also Waymo, which could all potentially be worth hundreds of billions of dollars on a standalone basis in the future, depending on execution, of course. And in terms of their underlying profitability, many investors did express concern, I think, in the earlier part of this year about the unit economics of this new era. So I think in one of the recent interviews where Sundar Pichai, which is the CEO of Google, puts it, I think the core focus here is to lean into the user experience as they've done since the founding of Google. It's in their DNA. Lean into the user experience, and over time, they'll figure it out and monetization will follow. Answer some of the naysayers' concern to the extent of the cost of serving a query in this new AI era. I think he said that I'll wager a bet on Google's infrastructure. And for myself, I am adopting the same thesis here. So in terms of the bearish concerns for Google, I think plaguing the name today is always on the topic of innovator's dilemma. And I think we are in a slightly better state today compared to say 12 months ago, especially after they lean in heavily into many of these experimentations. So Google, in a general sense, if you think about it, they have unparalleled distribution, they have extremely solid properties and digital assets, they have good growth, they have great penetration, but I think the ultimate bear case is how about the future? So OpenAI, which is the parent company of ChatGPT, is coming in very, very strong. Their user growth and adoption rate continues to climb 45 degrees to the right. And considering my own personal search behavior, I think Google is in a relatively precarious position because the bear thesis actually look pretty real and very unforgiving if it actually turns out to be true. So compared to quote-unquote normal software companies, which we have seen most of them getting disrupted and being sold down very aggressively in 2025 as well, due to a lot of all these emerging AI trends. I think Google is a different monster with a much more entrenched mode, but that said, it does not mean that they are untouchable. Hence, I think many investors, myself included, we are putting them in the continued monitoring pile, and we want to see how fundamentals continue to progress from here. So crunching some of the numbers, looking at the valuations today, similarly, if you look at free cash flow yield or trying to project out their free cash flow, they are spending and they are sinking so much money into capital expenditure. So their free cash flow yield now is only at 1.7%. Anything below 2% means that they are trading at a 50 times price to free cash flow. That's a pretty huge number if you ask me. But if you look at in terms of other metrics like a forward PE ratio, Google is trading at 23 times. And this is actually lower than the S&P 500. So if to compare in terms of a like-to-like quality, I do believe Google is definitely a much higher quality business compared to the general S&P 500. And not forgetting that we are still expecting top line 10 to 15% revenue growth rates. So if you do a PEG ratio, I think it's closer to 1.3, 1.5 times. I think it's still pretty fair to me. I don't necessarily think that Google is superbly overvalued in this case. My personal own remark, I think in this next wave of this whole agentic AI integration into the general lives of normal human beings, and I do believe that the edge in this next frontier is distribution. And Google definitely controls the on-ramp through its different YouTube, Gmail, Google Maps, entire suite of properties. And of course, all that I've shared is just in theory. I think we have to see how things are being executed in time to come. So the fourth company on the list is Moutai. So I've kept the investment thesis relatively short. To me, I do view Moutai as basically China's liquid gold. So there are very strong elements of cultural significance and status, which enables them durable pricing power and very inelastic supply. So it sometimes can even function as a collectible, which appreciates in value the longer you hold on to them. And yes, it's a luxury product with a lot of branding and signaling involved, which might prove hard to quantify, but it has stood the test of 20 odd years since the time of its founding. And some of these antitheses that surface up to the top, especially in the last 5 years, is that first, there is this idea of policy shock and the anti-corruption crackdown. They have basically reduced the conspicuous and the very showy or flashy consumption on many of such luxury products, especially in official public events, whilst also trying to reshape the ethos of frugality and humbleness. I'm not too sure if you are ever able to tame the need for face in the Chinese DNA, but I think that's besides the point. And there are also potential considerations where you can observe some sort of a consumption trend shift, especially in the younger crowd. And I do have a small pushback here where we have to distinguish not consuming Moutai and not knowing of the brand itself is two different points. And the prevailing antithesis, which is these two main points, has been penalizing the stock over the past 4 years. And it's the classic case of this constant worry amongst the investor psyche about when this thesis will break, whilst looking at their revenue, profit, margin, and dividend per share continue to climb to an all-time high. And it's definitely a mismatch between investors' expectations and the reality of how the company is printing their numbers. Although, I think it's also true that we have seen some sort of a price adjustment to the downside during the tough periods of the last 5 years of some of its entry-level Moutai products. So in terms of the valuations today, Moutai trades at a forward PE of 18 times and a free cash flow yield of roughly 3.6%. That's 28 times price to free cash flow and a dividend yield of 3.61% as well. So in my own personal opinion, I think it's fair. And in fact, I don't think it's egregious to actually call this an undervalued potential investment idea today. So moving on to Meituan. The investment thesis is as follows. So Meituan actually converts the near-me intent through eating, visiting, or buying into transactions and takes a toll via ads, commissions, and fulfillment. So they have actually built out a two-sided marketplace system, which is on one hand the demand side, bringing in enough traffic, building out the network, and to cementize the consumer habit. And on the other hand, the supply side, which is to offer the depth and breadth of services so that consumers remain sticky on the network, and also the fulfillment network and density so that they can operate high quality services. And Meituan has essentially built out a whole ass ecosystem around its strength and first mover advantage to their back-end analytics, point of sale system, algorithm, you name it. So food delivery as a business is an incredibly difficult landscape. It's brutally hard to win with very low margins to sustain. But Meituan actually managed to carve out this niche and dominated with pristine execution and actually turned profitable. And that's of course before the upcoming delivery war that they're currently embroiled in. And Meituan is undoubtedly still the leader in food delivery with automation as a potential catalyst in the horizon as well. And the antithesis basically revolves around the subsidy war today. So with JD.com and Alibaba's Lululemon back into the delivery picture, I think the worry is that the price war might turn structural and that Alibaba might also have no intent of making this a profitable arm of their business, but instead try to monetize it elsewhere, and Meituan will be at a structural disadvantage because they have no other engines rather other than this food delivery business. So Lululemon, which is owned by Alibaba, tried to penetrate into this business 5 years ago, but has stopped since and stagnated until they reignited this quote-unquote war again in 2025. And if history do serve as any guide, this might be a common recurrence in the future, and who knows when this would end. And the word on the street is that they do expect some sort of a high tide, low tide environment in this entire food delivery space. When Alibaba feels like it, they can ramp up their investment and subsidies. And if they feel like they have gained enough market share, they can then adjust their investment and subsidy down again. So the initial thesis of this two-sided marketplace being very hard to replicate is also kind of mooted when a juggernaut, like Alibaba in this case, with extremely deep pockets, actually step into the market and spend with no end in sight, in the short term at least. Ultimately, I think the business economics will still have to make sense, and consumers will decide with their wallet in terms of whose services they actually consume in the longer term. However, I think the saving grace here is that if they're able to strike some sort of equilibrium and to normalize their spending and subsidy and not to squeeze the margins down to zero or worse still even to negative, then this will result in a kind of a win-win with a duopoly network between Alibaba and Meituan today. So in terms of valuations, there's not much cash flow or earnings to look at because they're all going to turn negative in the upcoming 2 quarters. We will try to project out in the end game or out into the future how it would look like. So assuming in 5 years' time, which is by 2030, they can organically grow their daily orders to roughly 150 million sustainably, which is what they are currently doing, but that's given the backdrop of all this crazy subsidy. So assuming that in 5 years' time, their daily order actually don't grow, just remain constant, but at least at a sustainable rate, and assuming that they're able to make $1 RMB profit per order, that means that they're printing roughly 55 billion RMB annually, and that equates to 7.7 billion US dollars. And if you apply a 20x earning multiple on that 7.7 billion profit, that's roughly $154 billion US market cap. And today, they're trading at roughly $80 billion. 5 years' time, they're able to grow from 80 billion to 154 billion. That's roughly a 14 to 15% CAGR, if I'm not wrong. So That is when you try to table the end game of Meituan in 5 years' time, and assuming that all these subsidy will actually normalize and they pull back these numbers. So this is actually based on my conservative case on how I look at Meituan's business today. But at the end of the day, at least in the short to medium term, most investors are still concerned about how far and how much Alibaba wants to push this unprofitable business down the drain. Moving on to Amazon, the investment thesis is that Amazon has always been a very interesting growth story since the tech bubble boom. And Amazon today offers significant diversification and optionality as they expand their operations across so many different business verticals, from retail to cloud, to AI and robots, to advertising and streaming, etc. So AWS, which is Amazon Web Services, has been the crown jewel of the business, accounting for most of its income and profits, whilst I'm still holding the fort as the leader in the cloud space against people like Microsoft Azure, Google Cloud Platform, and also the up-and-coming Oracle. So they've also historically suppressed their margins through very heavy investment cycles, and hence it gives them a lot of room to reconfigure their revenue mix and margin profile through automation, through operating leverage, through robotics, etc., which makes investors very excited for more to come. And I think there's a very famous saying for Amazon investors is that your margin is my opportunity. I think that if Amazon wants to take over or penetrate into a particular industry, I think the incumbents will be in for a headache. So the antithesis for Amazon revolves around 3 key points. First is, of course, in terms of the AWS growth slowdown. It's starting to raise some yellow flag amongst its investor base, as we are seeing a lot of deal making happening with its competitors, specifically Microsoft Azure and Google Cloud and Oracle. Even though AWS growth and margins are still trending up, could mean lesser profit and margins. And on the second point, this constant worry of retail cyclicality and the sourcing of products and supply chain amidst this whole US-China tension, it's harming demand, it's harming growth, and it could potentially eat into their margins as well, which will also stall the advertising side of the house. And lastly, of course, this capex spending, it will scare investors from time to time, and given their very infamous history of investing for the long term, and the results of those spent today will only come out 3 to 5 years later, which will cause uneasiness, especially in times of uncertainty. And this capex spend concern is not so much just an Amazon problem, but most of these big tech companies that are just flushing their free cash flow down the drain into this big mega project called AI. So looking at the valuations today, their forward PE is at roughly 30 times. For their free cash flow, if you adjust for share-based compensation, is roughly negative. Their price to operating cash flow is 19 times, and their median for the last 10 years is 19.4 times. And their expected revenue to grow between 10 to 11% in the next 3 years. So if you adopt a historical lens, I think Amazon is trading below the historical range, whether is it on a forward PE or operating cash flow perspective. But I think 2 comments before we go is that 2 words tend to come to mind when you talk about Amazon. Firstly is, of course, in terms of their track record of execution and investments. So that's why I think long-time Amazon investors are not necessarily concerned about their free cash flow expenses and how they are allocating their capital. And the second word is definitely on optionality. I think Amazon is one of the more very diversified big tech out there, and they tend to have a lot of all these core options being embedded into the business. And moving on to the next company, which is Taiwan Semiconductor, the investment thesis is that TSM is a pure play win-win chip manufacturer. So the dynamics of these semicon companies are pretty interesting. So TSMC specifically actually doesn't compete with their customers, unlike Samsung or even Intel. So in the chip manufacturing business, it requires continuous capex injection and upkeep, and just like compounding, it's hard to catch up once you snooze. And at the heart of this entire AI boom, I think the leading manufacturer of these semicon chips, which is TSMC in this case, makes them one of the most consequential companies of our time. And this might completely alter the demand side of the curve. So looking at the antithesis, of course, you have the general talking points of geopolitical and export controls due to the geographical considerations. And I don't think I have to spell out. I think it's in the name itself. And they tend to also be caught up in the crosshairs of many of these tariff concerns, especially being strong-armed to build overseas fabs, which might add to their costs and inefficiencies. But a side note here is that I don't necessarily think that it's a big issue as long as they can maintain the strong long-term partnerships with their downstream customers and quality control. They can very easily pass down the costs to companies like Nvidia and Apple, for example. So in the chip manufacturing business, they do have this so-called inherent advantage or disadvantage. They tend to not be the highest margin compared to the chip designers, and they have very high upkeep and capex costs to maintain. And this ongoing investment could be seen as some sort of a barrier to entry to some investors to further deepen their moat, but this ongoing requirement could also be the downfall of the company if the management doesn't steward the capital well enough. And I believe I heard this comment from Munger before, when he was describing his disdain for some of this chip manufacturing company. He said that it's like playing poker, and if you have to go all in every hand, one day you'll get caught. Something to that effect. And that's just the general law for companies in this semiconductor manufacturing space. So in terms of valuations, TSM is currently trading at a forward PE of 24 times, a free cash flow yield of roughly 2.1%. If you're using relative valuation, comparing it across the last 10 years, they are over their historical median, and I think rightfully so, because the name of the game has essentially changed with this entire AI thesis, and their expected revenue growth rate is in the north of 15 to 20% in the next 3 years. So just one remark from me is that I think this AI boom is indeed spectacular and exciting, but the natural laws of cyclicality in the semicon space cannot be stopped. But I do agree that it could potentially alter the general normalized demand side of the semicon curve. But to what extent, I think we're still in the midst of trying to discover that number. Now, moving on to Lululemon. So buying the stock today is basically a vote of confidence in the potentially enduring brand equity that they have built over the last decade. So they sell a repeatable brand comfort and certainty with the best-in-class margins through their grassroots community and the direct-to-consumer business model. So they are probably still extremely under-penetrated in the men's and international markets, which could be the next growth curve. And in terms of their target projection, they have been quite on target in delivering expectations under Mr. McDonald's Power of 3 and the upcoming Power of 3 times 2 in 2026. Antithesis, I think growth has been slowing down significantly in their matured markets, especially North America and Canada. And we are seeing quite clear signs of brand fatigue, or it could be just the loud minority. I'm not too sure. I think it is also relatively hard to sort of quote-unquote determine the position of the brand in the minds of the general populace, and we can only look at a lot of all these backward-looking data, which will be reflected in terms of growth, in terms of margins, so on and so forth. And it also seems like there were some management missteps on color and focus on assortment when customers are complaining online about the fabric, material, and newness of styles. So numbers, especially for margins, have yet to experience a Nike-like erosion, but it does seem like the market is pricing in very subdued growth expectations and the weakening of their brand positioning. So looking at the valuations, their forward PE today is at 14 times, free cash flow yield roughly 5.8%, trading at a 17 times price to free cash flow. I think compared to all of the different companies that we have talked about, Lululemon definitely takes the cake in terms of just looking at absolute numbers perspective. They are considered the cheapest of the lot, but rightfully so as well, because their revenue growth estimate for the next 3 years is between 4 to 6%. And they're sitting at one of the lowest rung of all the portfolio of companies that I hold. I think when comparing both Lululemon and LVMH, both of them actually relies very heavily on the Chinese consumption recovery. But I do believe that LVMH is a quote-unquote safer bet with its historical and cultural significance versus Lululemon, which is an up and rising brand, which could lose adoration quickly. I think LVMH is probably the safer play, but Lululemon could potentially promise you a greater upside if they're able to basically get their shit together. And the last company that we're going to cover are Meta Platforms. So the investment thesis for Meta is that it has been one of the front runners into integrating AI into its day-to-day through its algorithm, its ad targeting, and it embedding LLM in your face through Instagram, WhatsApp. And immediately, they are able to harvest the positives of integrating AI, and it's reflected in their earnings through the efficiency and ROI gains. And as a platform, it enjoys extremely strong network effects, and they own the world's attention OS through its family of apps. And to add, I think Zuckerberg's recent obsession with the next computing device through the VR AR glasses works out to be an inbuilt long-dated core option if it eventually plays out. So they've executed spectacularly well in the last 3 years, circumventing all the bear case being thrown at them, like the Apple privacy update to the TikTok competition to even losing relevancy to the younger crowd. And just looking at the business fundamentals today, they are sitting at record gross operating profit margin, monster growth rates even at a very high base, and reducing their shares outstanding aggressively. The antithesis, I think advertising as an industry is easily influenced by the macro cyclicality, but it's just a short-term issue, so not too much concern there. So the AI spending and capex could be a potential concern down the line if they outrun the monetization gains, especially when the numbers get out of whack and Zuckerberg is just throwing money at this AI problem. So in terms of their valuations, they're trading at a forward P of 24 times, a free cash flow yield of 1.8%, a price to operating cash flow of 17 times, even though the median is 18 times, and the revenue growth estimates is between 14 to 20% in the next 3 years. I'm not too worried about the business fundamentals per se, but just how the market is trying to price in their future expectations. So to put all of this together, I think this is my final verdict using that same traffic light approach. And at one glance, I think it's quite clear which companies that I will probably add if there is potential opportunity in the upcoming volatile 2 to 3 weeks, which companies are a very comfortable hold, and which companies are in the more quote-unquote volatile zone. So there really isn't any company that is residing in the sell section for now, but I think this just serves as some sort of a flexible guide, and we can remain fluid in our decision making. So after this exercise, I hope that you should have a much clearer picture of your own portfolio, and it should give you more clarity as to how you want to navigate the volatility ahead. And truth be told, looking at these 9 different companies, I'm just short of giving you individual purchase price targets on when to buy the company, because I do believe that the buying price really is dependent on your own individual portfolio exposure and what you're comfortable with. And of course, this exercise also serves as some sort of an accountability as well when you look back in the future for reference. So with this consideration, phase 1 being the vibe check, phase 2 being a deeper dive. In phase 3, I think after being clear of what you actually own, what you might then want is to keep some sort of a shopping list of stocks at the side so you can also monitor for potential opportunities as well. And it's definitely recommended to not be too long a list because you probably wouldn't have time to monitor all of them either way. So in this phase 3 of the watch list, I will also have to rank them accordingly in the same format against the different benchmarks like my understanding and conviction and also potential attractive valuation points. So after thinking through, I wouldn't be making a third video in this video series, but instead I'll send a newsletter out via Substack. So if you're interested to be notified when the watch list is out, feel free to join the Substack link in the description below. And with that in mind, I hope you enjoyed the video, and I'll see you in the next video. But more importantly, and hopefully, I'll see you guys on Moon. Goodbye.